Hey, it's Stephen Neely, Certified Financial Planner with Fortress Capital Advisors. In this video, we're going to talk about one of the greatest investors of all time, someone who you've likely never heard of and who sadly passed away this week at the age of 86. I'm talking about Jim Simons of Renaissance Technologies. You may be surprised to learn that the returns of his fund just dwarf those of somebody like Warren Buffett. And even though the exact strategies remain a secret, I think there are a lot of things that common investors can take away from the way that Jim Simons and Renaissance operate, and we're going to talk about those things in this video. So I'm going to give you a couple of central insights I think that you can take away from them that are going to help you as an investor. And then I'm going to finish the video with 4 book recommendations that I hope can help you become a better investor, as they've certainly helped me. So let's first talk about Jim Simons' background. And one thing that is probably surprising to a lot of people is that he didn't come from a Wall Street background. In fact, he was a renowned mathematician who had won several awards. And he was even a code breaker in the Vietnam War, helping for the Cold War. And he didn't even start his investing career until, well into his 40s, which is quite a different path than most people take in finance. One reason I would guess that he was not as famous as Warren Buffett, even though the returns were so spectacular, is that Jim Simons is what you call a quant trader. And what that means is they use mathematics to predict financial markets. And so if anybody's ever interviewing Jim Simons, he has no view on any stock whatsoever. He couldn't care less about Tesla or Amazon or whatever it is. What they're doing at Renaissance is they're taking thousands and thousands of inputs and they're sifting through the data to find patterns in it. And then they're just based off of the patterns, they think, here's this prediction, and they're going to make a bet on it. And that bet could be seconds to minutes to maybe days or weeks, and then they're out of it. So if you interviewed him, there's not a lot of interesting stories that he's going to tell you, unlike you would find in a lot of CNBC interviews where they have these guys come on, they're plugging some investment thesis. Well, quant traders don't care about any of that. Between 1988 and 2018, when we have the best data on the Renaissance Medallion Fund, it produced a return of more than $100 billion of profit. They average returns of 66% per year. And after their exorbitant fees, they still netted 39% per year, which is just remarkable and leaves any investor that you can really think of in the dust, right? Warren Buffett, Peter Lynch, Bill Miller, George Soros, none of those guys even came close to returns like that. Now, I assume that most of you, like me, are not rocket scientists or mathematicians, the same kind of people they hire at Renaissance. And so what could you really take away from what they were doing? Well, I think there are 2 really important lessons that you can learn from them. Number 1, picking winning investments isn't the most important thing. What's interesting is that in interviews, they claimed that really only just a little bit more than 50% of their investments were actually winners. So more or less, basically picking a winning investment was like flipping a coin for them. And yet, their returns were just simply magnificent. And so that should teach you something as an investor, because what you see on the internet every day is that somebody's going to be pitching you on, oh, you need this investment strategy, or you need this specific investment to succeed. And that's simply not true. In fact, picking the right investments, if you don't size the positions correctly and you don't have good selling decisions, you can actually still be a very poor investor, even if you got 80% of your investments right as far as them being winners as opposed to losers. You can take venture capital as a great example. So in venture capital, the hit rate's like 10%, meaning that only 1 out of 10 investments is going to be a winner for them. And yet, venture capitalists have some of the higher returns out there as far as asset classes. So as far as I know, the average annual return of venture capital pretty much has doubled what the general stock market has done. And yet only 1 out of 10 of their investments are actually winners. And so even with 90% of their investments being losers, that one investment makes such a huge gain that it makes up for all of that and gives them, pretty outstanding returns on average. The second big takeaway I think you can get from looking at how Renaissance operates is that no matter how confident you are in your strategy, it's not going to matter if you don't remain solvent. And I'm going to give you a suggestion for a book to read here in a minute about Jim Simons and Renaissance, but the big thing that struck me was the humility from Jim Simons. These guys were quant investors and they had ultimate faith in their investment strategies, but there were a few times when things got really, really weird and their signals just went haywire. What struck me about the way Jim Simons operated is that he would just say, hey, we're hitting pause here and we're not going to continue losing money because if we do, we could go bankrupt, which is very, very smart. There are plenty of investors out there who hit a really good streak and their strategy worked well, but when things went wrong, they showed no humility and they just kept on going at it. And most of those investors are gone now because their funds shuttered because they had such terrible performance. And you as an individual investor can take away a lot from that too. When things are going haywire, you need to take a step back and hit time out, right? You can always go back in and do things when they normalize. And so we're going to talk a bit more about those concepts as we go through the book recommendations that I'm going to make. So I'm going to put these in pairs. So the first two are actually what I would call lessons in basically a contrast in how not to invest and how to invest. And so the first one is When Genius Failed, The Rise and Fall of Long-Term Capital Management by Roger Lowenstein. And the second one is The Man Who Solved the Market, How Jim Simons Launched the Quant Revolution by Gregory Zuckerman. And so, this is the book if you want to learn about Renaissance technologies, you read that one. But I would suggest reading both of them because the contrast in what to do and what not to do is just so stark, and you'll see that. So what's interesting is you probably never heard of long-term capital management if you're not in the financial services industry. And these guys were quants, much like Renaissance technology. And there was a period of time in the 1990s where these guys were just on fire and they were returning 30, 40% a year. And I mean, everybody wanted to give them their money and they just had to turn capital away. The problem for these guys was they thought they were smarter than everyone. And something happened in the markets with the Russian ruble crisis in 1998, and their strategy went haywire and they started losing money hand over fist. And a lot of the money they had was borrowed from banks. And so their collapse was so catastrophic that the Fed had to come in and bail them out because they were worried that the entire financial system was going to collapse if they didn't. Now, you read about Jim Simons and Renaissance technologies, and even though they're also quants, the big difference is that these guys actually showed humility. Even though they were really confident in their strategies, when things were going wrong, they would hit pause to go, you know what? Something's not right here. Let's live to play another day, which is a huge contrast to what they did at Long-Term Capital. The second thing I would emphasize, especially in the Renaissance Technologies book about Jim Simons, is that if you're an investor, you need to kind of know what you're up against. So if you're a day trader and you use a lot of quant strategies, you should read that book and go, man, wait a second. I'm competing against these guys and I literally have no edge whatsoever competing against rocket scientists and mathematicians. If that's the case, you need to find a way to play a different game. There's still plenty of ways for you to be successful as a retail investor, but it's not going to be competing against these guys, right? You simply just don't have the firepower to do so. So you're going to have to think of something else. And that's going to get us into the next couple of books that actually are about trading. And one common theme is having an edge. And you're not going to have an edge competing against Renaissance. So let me pivot over here and talk about the next two books. I talked about it earlier when we talked about picking winning investments. So on the internet, you're going to have all of these charlatans telling you, well, you just need this investment or this investment strategy and then you'll be successful. But nothing could be further from the truth because the reality is Nobody with a successful investing strategy is going to sell that on the internet. That's why Renaissance is so secretive about what their actual strategies are. But the reality is there are certain principles that everybody could use to become a better investor or trader. And that's why I love these two books, because they focus on those types of principles rather than a specific strategy. And most people miss that. And so I'll kind of get into what that really is here in a second. But the first book is The Laws of Trading by Augustin LeBron. And this guy was a trader at Jane Street, and I think he does a really good job of laying out nice processes and procedures that everybody should follow as a trader. Number 2, you've got Alpha Trader, and this is probably my favorite one. If there's one book that you should read today as an investor or trader, I would suggest this one. It's by Brent Donnelly, and he's been a prop trader for a long time. One thing I would stress here too is, both of these are geared towards traders, but really, in my mind, the only difference between trading and investing is your time horizon. So a trader might be in a trade for seconds or minutes or days or weeks, and an investor might be in an investment. Hopefully, they generally go into it thinking probably in terms of years. But a lot of the same principles can be applied to both. And that's why I say I would still recommend using both of these books, and then you can modify these principles kind of based on your own need. Let's take a look at a couple of common themes from these that I think would help anybody. So the first one is risk management. Both of these books emphasize that. And what that means is not only just avoiding big losses. I mean, obviously that matters, but it's more about knowing when to gear up taking risk and then when to tone risk down. And that's really what separates good investors from bad. In a nutshell, one thing that Brent Donnelly's book stresses a lot is you should never always have the same position or position size on at all times, because different environments call for different investing styles. And a lot of that comes down to when you should take more risk and when you should take less risk. If you want to be a great investor, that's something you need to figure out. The second common theme that both of these books have is, if you're an investor or trader, you need to be very, very clear about what kind of an edge that you have. And an edge here just means advantage. I always love to use the analogy of flipping a coin when you think about investing and investing success, because you come across a lot of what I would call overconfident investors, and they think, hey, I picked a few investments, they went up, and you feel like $1 million. I mean, I do it too. But just because you picked a few good investments, it doesn't mean you're investing genius. And so think about the way that flipping a coin works. If you had a fair coin and you flip that thing 1 million times, there's going to be some streak in there where you hit heads 100 times in a row. And that's just pure randomness. I mean, that's exactly how randomness works. And it has nothing to do with your skill as a coin flipper. So if you think about financial markets, you've got millions of different actors out there, and everybody is competing fiercely. And at any point or another, somebody is going to hit a streak where they make a ton of money. And these are the guys that you're always going to see on YouTube or Facebook, beating their chest about how successful they are. But unless there was a reason that these guys could point to for that's an actual, true, repeatable process that they can continue to exploit, well, you can't really tell the difference between their success or luck. And so my point to you is, if you're an investor, you need to be very thoughtful and understand very clearly what gives you an edge. And going out and picking a company to invest in because it's a good company isn't any kind of an edge that you have, and you need to be honest with yourself. Whatever market or investment that you're doing, you need to know this thing in and out. And unless you do, then you don't really know if you're lucky or not. And so, it gets into, how do you size positions? How do you exit them? How do you react to different regimes? All of those things are going to be what makes you a really good investor and probably give you an edge over other retail investors. In summary, right? You got to manage risk. You need to have an edge. You should be process oriented. And finally, you got to show some humility. It doesn't matter how good your strategy is if you end up going bankrupt because you hit a streak where it just didn't work for a while and you took on way too much risk. So I hope you found this helpful. I post videos weekly about retirement and investing, so if you liked it, hit subscribe and you can get my next video. Take care.